Hey everyone, hope you're doing well. Will Jerome Powell, along with the rest of the Federal Reserve, actually be able to pull off a soft landing? It's an important question because it affects us all and our wallets. So let's discuss it here today, along with some potential challenges that might get in the way of them accomplishing that. As always, my name is Derek and I got my degree in finance, so you don't have to. Before we begin, let's define what a soft landing actually is. And this is just fancy talk for the Federal Reserve being able to lower inflation down to its target rate or close to its target rate of 2% without sending the economy into a recession. Because remember, when you increase interest rates to fight inflation, you also increase the risk of recession because high interest rates slows down business activity because consumers spend less if it's more expensive to borrow, and businesses spend less on research and development and growing their businesses because it's more expensive to borrow. So that is the major concern when you raise interest rates, that a recession might follow. Now, for basically the last entire year, many institutions, investment banks, regular banks, Bank of America, everyone was calling for a recession. Not just because of high interest rates in the fight against inflation, but because of the speed at which those interest rates were raised. Remember, for the last decade, the federal funds rate has been near zero. And then all of a sudden, in the period of 1.5 to 2 years, that funds rate goes from near zero to 5.5%. That is a huge increase. And basically what it causes is like a shock and awe in the economy, because this economy in particular has been built over the last 10 years on the back of very low interest rates. So when you raise those rates, now you have businesses that are shocked and are not able to borrow money as easily to do research and development, to expand their business, to build new stores, etc. And then consumers are also shocked because now their credit card loans are higher, their personal loans are higher, their car notes are higher, and real estate is higher. And in fact, over the last 60 years, there has been 11 of these periods where we had a rapid increase in interest rates. Only one of them has resulted in a soft landing. That means 10 out of 11 resulted in a hard landing, aka a recession. So when everyone was calling for a recession, the data did support them. Now, if you know me from here or Instagram or TikTok and you've been following me for a while, you probably know that I've also said, how are we going to have a recession if everyone is planning or expecting a recession? Now, that you also know, if you know me, you know that I love data, and that is not really a data-driven statement, but I digress. The fact of the matter is the data did support a recession. Now, we haven't gotten a recession yet, and I know some of you are watching and might be saying, we're definitely in a recession. And I agree that we are in a recessionary environment, and as a consumer, we feel like we're in a recession. That mostly has to do with prices, which I will talk about here in a bit. With that said, what is the definition of a true or a technical recession? Well, this is 2 consecutive quarters of negative GDP growth or diminishing GDP growth, depending on who you ask, and that really hasn't happened yet. In fact, if you look at the data, we're nowhere near a recession. So unemployment is currently at 3.7%, which is very low, especially in the face of high interest rates. And then when you look at GDP growth, it's above 5%, which is very, very good for a mature economy like the United States in any environment, especially in a high interest rate environment. Now, we do have to understand that these pieces of data are lagging in nature, which means as time progresses, next month, etc., these numbers are going to trickle up. Well, unemployment is going to trickle up and GDP might trickle down as the market experiences and feels more of this high interest rate environment. Regardless, businesses and consumers have so far been very resilient in the face of high inflation and high interest rates, more resilient than most economists had predicted, and that is one of the main reasons why we have not entered a recession. Now, with that said, these high interest rates have caused some major problems, and I can think of 2 off the top of my head. One is the banking crisis. I'm sure we all remember that, of just a few months ago. Now, the reason this happened is because basically banks hold treasury bonds because treasury bonds are very safe. Now, what ended up happening is they hold these bonds and then the Federal Reserve raises interest rates. Now, these bonds pay out a fixed amount. So when interest rates are raised, the yields on these bonds also have to increase. If you cannot change the payout amount, you have to change the bond price. And the only way to do that is to lower the bond price. So the market naturally lowers the bond prices to increase the yield, right? Because $1 is a higher percentage of $10 than it is of $100 in simple terms. So because of that, the banks holding all these assets, they started basically becoming less valuable, and some of these banks failed, and that's exactly what caused the banking crisis. It was directly tied to increases in interest rates. The other area that we've experienced some of this, and that we are still experiencing some of this, is in real estate and in the unaffordability that most people are experiencing in the real estate market. Now, I do not think that interest rates caused the unaffordability in the real estate market, though they sure as shit exacerbated the problem because they made it more expensive to purchase an already expensive asset. So, yes, high interest rates have caused some problems, but when you look at the data, we are very close to avoiding a recession, and we are very close to pulling off the Fed's goal of a soft landing, especially when you look at one more crucial piece of data, and that is that there is almost a 100% guarantee. Obviously, nothing is 100%, but there is a very close to 100% chance that the Federal Reserve lowers interest rates in 2024. So, if the economy has held resilient so far in the face of these high interest rates, we are coming to the end of that period in 2023, and we should see cuts to interest rates in 2024. And this will cause a boost to the economy because lower interest rates boosts economic activity, which might further make the Federal Reserve's goal of landing this economy softly a real thing. Here's the thing. And this is kind of where we start to transition into the potential challenge that the Federal Reserve might face. This same reason that might cause a boost to the economy is also one of the main reasons that I see that could actually cause the economy to enter a recession. And it is because if interest rates come down in 2024 and inflation starts to tick up again because of this increased activity, the Federal Reserve might have to pause its interest rate cuts, or in a worst case scenario, start to raise them again. Now, inflation is also seemingly or looking to be quite sticky in the 3% range, and there are other very intelligent people who are echoing this concern. And this again has to do with the fact that consumers and businesses are resilient. When you have a resilient economy, people keep spending in the face of these high interest rates, which causes inflation to become sticky. And when you look at some of the numbers, we are kind of stuck in the 3% range when you look at CPI, and more importantly, when you look at core inflation as well. But when you look at services, okay, when you look at services, which is one of the main metrics that the Federal Reserve will use to make policy decisions, because this is a service-based economy, okay. We all have not all of us, but a lot of us have service-based jobs, and this economy is built on services, financial services, tech services, etc. So when service inflation is still sitting at 5% and above, that symbolizes that this economy is still a little too hot, running a little bit too hot for the Fed to reach its target rate of 2%. So when the Federal Reserve starts cutting rates in 2024, which it's almost a guarantee that they will. My major concern is that this causes a boost in the economy, which is a good thing, but it also causes a rapid re-increase in prices. If this happens, I could see the Federal Reserve having to pivot again, which would be extremely, extremely detrimental to the overall economy. And maybe pivot is the wrong word. I could see the Federal Reserve having to pause their interest rate cuts or hold interest rates higher for longer, as in taking the time to cut rates much longer, which means that the economy would have to remain in a high interest rate environment for much longer than expected, which is the major concern when it comes to a recession. So those are my thoughts. It looks like the Federal Reserve might actually pull this off, but the main concern is also one of the main benefits, and that is that we are coming close to the end of interest rate increases. Most people say that we're already at the peak, and we're about to begin the interest rate cuts. And those interest rate cuts can spur the economy, but they can also rapidly accelerate inflation. One more thing that must be touched on. Even if the Federal Reserve continues to cut rates in the face of inflation coming back, that will only make matters worse. So in that scenario, which is not likely, but it is a possibility, in that scenario, you basically have two negatives. You either raise interest rates or you pause your interest rate cuts, which makes the economy remain in a high interest rate environment for longer, which can cause recession, or you continue to cut, and inflation rapidly increases again, which leaves consumers with high prices once again. So both are negative. Hopefully we do not enter that environment, but that is the major concern that I see moving forward into 2024. Barring that, it does seem more likely that the Federal Reserve will pull off its soft landing. Now, before I end this video, I want to touch on probably what you might be screaming at your phone about right now, and that is that the fact that it sure as hell feels like we're already in a recession. And I agree with you, I understand it, and I completely respect that opinion because it's an opinion that I share. But that mostly has to do with prices. And Jerome Powell himself actually did say this at the most recent Fed meeting. He did admit that the reason why people feel, or why there's a disconnect between the data and how people feel, is because of high prices.
Well, inflation is coming down, and that's very good news. The price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like.
Remember, for the last couple of years, inflation has outpaced wages, which means that we have effectively become poorer, even with wage increases. So, and for a while there, inflation was 8 or 9%. Okay, so you have inflation here and you have wages here. It has outpaced it. So the only way for us to feel more financially secure is for wages to outpace inflation for many consecutive years, which it is currently doing. We do have real wage growth currently, but for the last couple of years we haven't, and that is why people, in a sense, feel, for a lack of a better term, poorer, because they technically were when inflation outpaces wage growth. And that is why most people still feel like we're in a recession, even though technically we're not. I hope I didn't drag out this video way too long. Basically, to summarize this, the Federal Reserve is closer than ever to pulling off a soft landing. At the same time, the major concern is the interest rate cuts that spurs or reignites inflation. If this video was informative, if it spurred thought, if you enjoyed it, and if you like personal finance, world economics broken down simply, you're in the right place. Please consider subscribing. This is a brand new, or relatively new, YouTube channel, and it is something that I'm very passionate about and I want to share with you guys for many years to come. And don't forget to turn on the bell notification as well so you don't miss the next video. We usually do videos on Tuesday. But if there's something that we need to talk about, like a Federal Reserve meeting, like an interest rate change, like a major bank that collapsed, or a major, any sort of major news, I will do a video Wednesday, Thursday, or Friday to bring that information to you as quickly as I possibly can. Other than that, I hope you have a fantastic rest of your day, a fantastic rest of your week, and I hope to hear from you in the comments and in future videos. Take care.